Now, with just over 10 minutes to go to the closing bell, we're looking at how to navigate the big picture with the Yahoo Finance playbook. Consumers are continuing to cut back on spending. That's thanks to persistent inflationary pressure. In today's playbook, we're taking a look at the discount names that are best positioned to benefit from the lower income shoppers trade down. We're joined now by Corey Tarlow, Jefferies Senior Vice President, Equity Research, and Brian Mulberry, Zacks Investment Management Client Portfolio Manager. Guys, it's good to have both of you on the show. And maybe, Corey, I'll start with you. You've gone through a lot of earnings reports now, Corey. You've listened to a lot of conference calls. What's your take on the kind of low-income consumer right now, Corey? How healthy and resilient do they look, just based on what you're hearing from your own coverage universe?
Good afternoon, and thanks for having me. So what I would say is that right now, the low-income consumer has clearly been pressured by the persistent inflation that we've seen. And the individual who was on before me cited that oil could be breaking higher. Well, one of the things that you monitor and you think about when it comes to dollar stores is, especially when it crosses that $4 a gallon threshold, you do tend to see traffic pick up at the dollar stores. And so as you have seen really robust inflation cooling some, but still sticky, potentially oil prices going up, it does spell for a consumer that is still very value conscious. We are starting to see some early signs of improvement in general merchandise at certain retailers, but it's still very, very early days there. So you're still seeing a prioritization of needs over wants.
Brian, I want to get your take on this as well, and whether, it feels like when you're talking about a Dollar General, Dollar Tree, Family Dollar, the trade down sort of stops there, right? So it would just be people not buying as many discretionary items or buying less of what they're buying. Kind of where are we in that cycle in your view?
Yeah, absolutely. And I'll add to the discussion where we find a clear dividing line for the consumer is whether or not you own your own home. Those people that owned a home and were able to refinance at a very low fixed rate aren't feeling the pinch of inflation as much as those people who have been renting since 2020. They're feeling everything. Rents are up 12 to 20% nationwide. Now we've got energy costs rising on the back of insurance costs rising, and that's really causing a change in the behavior from consumers where they're having to go and save money somewhere else. And so we're looking at these stores and their product offering. And Dollar General in particular is one of those places that has really made a key investment in perishables where you can actually get some fresh produce while you're there shopping for other items at a discount as well. And so that's really a big part of their growth, is to have more engagement for people who are already there trying to save money in their budget because of the higher cost of everything right now.
And Corey, I want to bring you here as well, because you cover those names. And it was interesting, Corey, to watch. I mean, Dollar General reports, gives an outlook. Investors clearly liked it. Dollar Tree reports and tanks. Brian touched on it, but I want your take, Corey, as well. What do you think kind of explains the diverging stories there?
Yeah, it's a tale of two businesses. I think at Dollar Tree, it's certainly a tale of two banners as well. For me, at Dollar General, it's all about traffic and market share gains. Dollar General has seen traffic increase in the last 2 quarters consecutively. They've seen market share gains in consumables in both units and dollars, and market share gains in dollars and non-consumables. So everything seems to be trending in a good direction there from a sales perspective. And then as we go to Dollar Tree, as I mentioned, it's a tale of two banners. The Dollar Tree banner continues to be very, very strong from a sales and margin standpoint. However, if you look at the Family Dollar banner, the Family Dollar banner has been very pressured from a profitability standpoint. And in fact, in the last quarter, it only generated $7 million of operating profit on a business that is multi-billion dollars in revenue. So that profit outlook for Family Dollar does give us pause when it comes to Dollar Tree.
And so, Brian, is it as simple as for investors to avoid Dollar Tree and maybe deploy some capital to Dollar General?
Well, and I agree with what Corey's saying. And then if I take it a step further and look at the forward guidance, you've got Dollar General who's looking to grow their footprint, expanding aggressively, remodeling stores, and also adding to their lineup in terms of available product. This is a good growth type of story. Whereas with Dollar Tree, they're cutting, right? They're going to end up closing around 1,000 locations of those Family Dollar stores. And that seems like a business that's in decline just from the top end of it. as we dig into the numbers, also agree that there's good profitability there, but how do we go forward from here? And for us, in the rising expense that we just saw from the PPI data, right? Input costs might not be as rosy as people think, especially with oil going higher. So now it becomes to operational execution. We know that there are cost savings out there, that there could be more efficiencies gained. It seems like Dollar General to us is in a better place in terms of controlling those expenses and having better margins from this point going forward. There will be some cost savings from the restructuring from Dollar Tree eventually, but they kind of have to right the ship in the near term.
And Corey, I know you agree at least with some of Brian's points though, because on Dollar General, you're a believer, you got to buy on that name. Dollar Tree though, you're on the sidelines, Corey. So what do you need to see before getting more bullish on that name?
I think it comes down to profitability. And ultimately, if you think about the path for Dollar Tree, the Family Dollar segment, with all the closures that were just pointed out that are occurring, again, about 1,000 stores, that's going to be over $700 million of revenue that is going to be lost due to the closure of these stores over time. And so that's a very sizable portion of the company's sales that are basically going to disappear with these closures as they slowly try to inch toward a more profitable enterprise over time. And so this is really going to be a show me type story for Dollar Tree, and it really needs to start, in our view, with an improvement in Family Dollar.
And there's one other retailer that I want to bring up with you, Brian, in particular, because I know you're watching, and it's one we haven't heard from yet in terms of earnings. That's Five Below, also in the discount space. It's a little bit different here, right, in terms of its profile, in terms of what it sells. My kids love going in that place, by the way. But how is it going to stand up versus these other ones?
Well, Five Below has a little bit different model, right? They're attached to some bigger mall type of footprints and larger store sizes, and they have a little bit more flexibility rather than tying themselves to just $1, right? It's $5 and below, and there's actually quite a few things in there that we know are well above $5. So they've got more price flexibility from just a consumer expectation point of view, and they certainly are targeting the preteen and teen market. I know my kids love going there as well, but it simply lacks the scale, right? We're talking about a business that only has about 1,500 locations compared to Dollar General at over 5,000. And just in terms of sheer scale of revenue, we're talking $3 billion or so in sales compared to the $38 billion in Dollar General. And so they definitely have more growthier type of a feel, but they're not quite knocking on the door of Dollar Tree or Dollar General just yet. But there is a clear I would say momentum behind the growth. The lower numbers mean that there's more energy behind some of the wins in terms of earnings beat and earnings expectations. And they certainly have a good business model because they're not carrying any debt on the balance sheet right now.
Brian, Corey, thank you both guys for joining us today. Appreciate it.
Thank you.